Hello everyone. So today in this video, I'll guide you through the key fundamentals and technical aspects that shape the crude oil prices. So friends, from understanding the inventory data published by the API and EIA to analyze the geopolitical events, the natural disasters, you will discover how these factors impact the price movements in the market. But here's the catch. Understanding the inventory data is not just looking at the numbers. It is the skill to decode what they reveal about the demand, the supply, and the market sentiment. And also, you will learn how to combine these with the powerful tools like CPR levels, then the EMA to understand the high probability trades. So, by the end of this session, you will have these powerful tools to turn the fluctuations in the market to your opportunities. Okay.
So in this session, we'll discuss the important data to look at. Okay. So important data to look at. So I told you this is with respect to the fundamentals. So we have briefly covered this about the fundamentals to look upon. I've told you already inventory data we use. And then we also need to see the other aspects like the price action, the indicators, etc. Okay, so here I'll explain this inventory data. I'll be discussing the API data, EIA data, and how you're going to analyze this data. So, and based on this, how you take a trade, combining it with the technical aspect like the normal price action indicators, EMAs, CPR, etc. Okay, so this is again very important for you to understand. Simply technical indicators won't work. Okay, because this inventory data comes weekly, API comes on Tuesday, and EIA comes on when they so weekly 2 days we need to watch this. So this is very important. So let's get into this inventory data. Okay, so as I told you, it is published every week. Okay, and what it is actually telling you, so it is the count of, simply I'm just writing the definition, count of oil stockpiles changes compared to the previous week. So this report is published every week. So previous week you get the stock, and then now you will see the change. So I would simply put the symbol delta. So delta basically indicate the change. So it is nothing but count of oil stock changes compared to previous stock. Okay, now what you can understand if this is lesser or if there's a decrease from the previous week. What does that mean? The stock comes down, which means demand is high. Okay, demand is high. That's why the stock is coming down. Okay, so if this is in decreasing compared to the previous week, demand is high, or it also indicate a less supply. So if the demand is high, I'll take another page and write. So if there's a decrease compared to the previous week, okay, when you look at the change, if there's a decrease compared to the previous week, what does this mean? This means there's a huge demand compared to the previous week because there are more consumers. So consumption is high. Demand is high means consumers are high. Or automatically you can also imply that supply is coming down due to many factors. It can be weather factor, it can be geopolitical factor, it can also be interpreted in this way. Supply has come down, okay, because of less production. In these two ways you can interpret. So simply when demand is high, what will happen with the price? Price will go up, or supply is low. What will happen with the price? Price will go up. So if you see the inventory is reducing, so I'll just write it here. Inventory is less or inventory is decreasing. It means bullish. Okay, inventory is decreasing, it is bullish. So what about the opposite? If increase in crude oil, then what will happen? It is the opposite. It will be bearish. So here in this situation I've discussed decreased. Now let's talk about increase. So now what if there is an increase? There is an increase. In case if there is an increase, when you take the change from a previous week, if there is an increase in inventory, so previously I was talking about decrease in inventory. So inventory is less. Now I am talking about inventory is more compared to the previous. Okay, then what will happen? It is actually indicating that the demand is reduced because the stockpile is more. Okay, that means demand is decreased. That means either due to consumption of oil, crude oil is reduced, or it can also indicate that supply is increased. That means production is increased. So when the demand is less or the supply is high, what will happen with the price? Price will automatically, price will decrease. So this is bearish. So this is what you need to understand. Increase in inventory or more inventory, it is bearish. Decrease in inventory or less inventory, it is bullish. So this is showing the decreasing scenario. You can see here decrease in inventory, which is indicating decrease in inventory, which is bullish. This is increase in inventory. As you see here, it is bearish. Okay, I'll just write it once again in a separate page. Increase in inventory. Okay. Decrease in inventory. What is your interpretation? Now, it can be from, normally it is from previous week, or it can be from the forecast also. See, you will be getting a forecast before this data comes. So, from forecast also, if there is an increase, still it is showing increase means demand is less. Demand is less means consumption is reduced or supply increased, or you can also interpret as production increased, which will lead to price decrease, which shows bearish. Okay, crude oil goes bearish. So I hope this is very clear. But you cannot take a simply bearish trade. You need to look at the levels, you need to look at the CPR, you need to look at the indicators, and then you will take the trade. Similarly, decrease in inventory compared to previous week. How you will see this? Where you will see this? Everything I'll discuss the previous week or forecast. Forecast means before the report published, you get the forecast. It could be what it could be. Okay, so what? So the actual one will be the published data, and what it can be will be the forecast. You know, GST forecast or GDP forecast. Okay, so what is expected is what you mean by forecast. So it can be from previous week or even from forecast. If there is a if there is an increase or decrease, still this is the case. Now decrease in inventory means I can write inventory is less. Inventory is less. Then it shows demand is more. That means stock is less. Why? Demand is more. Why demand is more? Consumption is more. Or you can also take it as supply is less. That is why inventory is less. The stock is less either due to two reasons. Either demand is high or supply is less. It could be due to production capacity issues, or bad weather, geopolitical tensions, etc. In this case, what will happen? Price will go up and crude oil will become bullish. But we will take trade again based on the indicators and the setups that we discussed. So this is two things that you need to understand with respect to inventory. Now, where you look at inventory, how to get the data and everything, I'll tell you. So let's say I'll give you one more example. So this is how it will be previous week. Okay, forecast and actual data. Okay, so previous week forecast, actual data. So let's say previous week forecast, let's ignore. Now we can talk about previous week and the actual. It was 4 million, okay, or negative 4 million. Now this time what happened is minus 2 million. So here what happened? Inventory is increased or decreased? Which number is lesser? Here this number is lesser. Minus 4 is negative. More lesser compared to minus 2. So here inventory is actually increased. 2 million increase is there. So in this situation, when you look at, when you see the data, you will see this in red color. So this will be written like 2 million. And this indicate bearish. Why bearish? Here inventory is more compared to previous. Okay. Or even in forecast, let's say it was forecast like 2.5 million minus 2.5 million and you got 2 million. So it is again lesser than the forecast also. That is indicating it is bearish. So simply if inventory is more than previous or inventory is more than the forecast, what is the sign? It is bearish. I repeat, if the actual inventory here in this example it is minus 2 million, is it more than previous? Yes, it is more than previous. Is it more than the forecast? Yes, it is more than the forecast. Then what does that indicate? It is because demand is less. Why it is more? It is because less demand. Okay, so I hope this is clear. Now let me show you one more example. Let's say this is minus 4 million. Okay. And let's say the actual outcome is minus 6 million. Then what will happen? What was previous minus 4? Now minus 6. It is lesser than previous. Okay. So previously it was minus 4. Now this is minus 6. So what does this mean? Inventory is less in this case. The inventory is less. So what does that mean? It is bullish. Okay, now assume that the forecast was, let's say, minus 5. So inventory, the actual inventory is less than forecast, is less than previous, which means demand is high. That's why it is lesser. So you just need to see whether inventory is more or inventory is less. If inventory is more, then it is bearish. If inventory is less, then it is bullish. As simple as that. Then everything else again depends on the indicators and you need to look at the price action. So we have already discussed which organization published this and everything. So I'll quickly go through that. EIA, that is Energy Information Administration, Energy Info Administration, and then API, which is American Petroleum Institute. So these are the two organizations published. Now out of which EIA create more volatility and more significance in India? This is due to the timing and at which it is published. I will come to that. Okay. So EIA report, it comes, if you see, it comes during, it is on Wednesday. If you look at EIA, or let's start with API first. API, this will be published in India, it will be on Wednesday 2 a.m. Indian time. Wednesday 2 a.m. Indian time. So actually it will be Tuesday 4:30 p.m. US time. Okay. So why API won't make much impact in Indian market is because it is published at 2 a.m. So our market is closed. So that volatility won't affect us. Okay. So I hope that is very clear. It is Indian time 2 a.m. So immediately there will be a volatility in the world market. But since we are not trading this time, it won't affect us. So now let's look at the timing of EIA. EIA, if you see, it will be on Wednesday, 8 p.m. Indian Standard Time. Okay, so Wednesday, 8 p.m. And after that, you will see very good move. So this is the Indian time. And if you look at the US time, it is 10:30 US time. Okay, so as I told you, which data is more important, more weightage when it comes to crude oil price, especially when we are trading in India, compared to API, it is EIA. Why? Because of the timing at which it is published. 8 p.m. This is the time where we are trading. Our market is open. Indian market is open. So which is more important for us? EIA data is more important for us to take the trade. Once the data comes, you have another 2 to 3.5 hours market is open. So you will be able to get good volatility also. And based on levels, CPR, other indicators, will be taking the trade from this data. What we need to understand, whether inventory is less or more. Okay, if it is less, what you need to understand, demand is more. So bullish. If it is more, demand is less, so bearish. So based on fundamental, you have taken this decision. Then you need to go with technical. That is our indicators, the price action, the levels, the EMAs, the CPR, everything I'll discuss. Okay, so you don't want to worry about that. Now, see guys, like normally when we have expiry, I'll just discuss this also. When we have an expiry on Thursday, assume that Thursday is a holiday. Then what will happen? Previous day will be the expiry. So here it is the opposite. If Wednesday is a holiday, then next day they will publish the data. In our expiry case, it will be the previous day. But here, if there is a holiday on this particular day, then next day they'll publish it on the next day. Okay. Now where you can find all these things? So let's look at that. What you need to do is you go to investing.com. Okay. The other websites also I'll mention. So go to investing.com. Okay. And in investing.com, you can see economic calendar. Okay. So in economic calendar, you can get all important, events. So I'll just take US, so you will be able to see all the important events here. Okay, so this is for today. You can give this today, and then if you want tomorrow, you can give this week. If you give, you will get whatever events are there in this week. So you can see here, as I told you, this 4:30 is the US time. Okay, so this is the US time, 4:30 p.m. That if you want, you can go here and you can change here. You can change to India so that you will be getting accordingly Indian time. So this is at 4:30, and this API weekly crude oil stock you will get, and you already have this now, that is previous. Okay. Now let's say this is minus 5 million. Okay, if it is going to be anything like let's say it is going to be 6 million, what does that mean? Minus 6 million, it is lesser than previous, which shows high demand. Then price will increase. Let's say this is going to be more. More means it is going to be minus 4 million. Minus 4 million means what? Actually, addition of 1 million. That's why I'm saying it is more. Okay. And then demand is less. That is why that addition came. So the price will come down. So I hope this is very clear to all of you. Okay. Now, you can see the stars, and then you can understand the events. The stars give more importance than more importance. Okay, so FOMC meeting minutes, etc. So you can see the calendar here, and you can again get the API inventory. You can search like that, just like that, and then you will get the API inventory. And so you can see here, okay, so you look at this, let's say July 16th, this is the data. So the same you will get here as previous. So this is the previous, this is the forecast, and this is the actual. Forecast means what is expected. So previous will come here, and this is the forecast. So if you look at this, it is minus 3.9. Okay, so what is actual? Actual is minus 3.9. So here, how will you interpret that? So if you look at the previous compared to that, it is more, right? Because you got 3.9, but compared to the forecast, how was it interpreted? It is less. So whenever forecast is there, you need to give importance to forecast. I repeat, whenever forecast is there, you need to give importance to forecast. So 2.47 was the forecast. Minus 2.47 is the forecast. And what is actual? Minus 3.9. That means it is less, which is a lower number. Minus 3.9 is lower compared to minus 2.47. So it is less. Okay, so less inventory means demand is high, price is high. So that is why this is given in green color. I hope this is very clear. Okay, so this is 3.9. This will go here then, and then next time it is again compared to 3.9, it is less. So that shows demand. Okay, then this time minus 4.495. But you look at the forecast here. Forecast is my point. Forecast is 0.85. Forecast is 0.85. So actual is lesser than that. So when actual is there, you need to look at whether it is lesser or not. Okay, lesser than forecast. See guys, when forecast is there, that is more important for us. It is actually measuring compared to the previous week. But when forecast is there, look at that. So it is 0.85. But what came was lesser than that, 0.18 only. So that is again bullish. So here it is minus 2 was the forecast, minus 5 which is again lesser. So that is a bullish. I hope this is very clear. Now I'll show you EIA data also. So here you can see EIA. So this 4.87 will go here. That is the previous. Okay. And then you can see forecast is 2.6. What is actual? Minus 3.7. So still it is less. Correct? Less means demand is more. Now compared to, if you look at July 31st, minus 1.6 is forecast. Minus 3 is actual, which is again less. Minus 3 is less than minus 1, right? Again here minus 1.6 is forecast. Minus 3.7, it is less. Now look at this. Minus 1.9 is forecast, but it came plus 1.3. So here if you see inventory is more, that means bearish. That is why you will see this in red color. Inventory is more compared to forecast. So this is forecast. When it comes to actual, it is more than forecast. So it is bearish. Now, in all these cases, compared to forecast, actual is less. So what you need to know, what is a forecast? That you will see there. And if inventory is less than forecast, what does that mean? Bullish. So you will see green. If inventory is more than forecast, what does that mean? Bearish. So you will see red. Okay. So basically this will tell you the demand supply equation. So I hope you understood how you get this. Now mostly if you see API and EIA will go together. Now mostly you will see API and EIA go together. If API is positive, EIA is also positive. Now if it is negative, EIA is also negative. But there are sometimes there can be a divergence. In this case, there can be a huge volatility. So you're expecting volatility when if there is a divergence between EIA and API inventory data. Okay, So remember this, API comes at around 2 a.m. Indian Standard Time, but this comes at around 8 p.m. Indian Standard Time. So which is more important for us? EIA is more important for us. Now apart from that, what are the other important aspects that we need to look at? We have already discussed about this in this previous session. So I have told you opaque meetings, so you need to have a watch on that. The meetings and the schedules will be fixed early, so it is nothing but organization of petroleum exporting and countries, so they decide the price moves and everything. Okay, so that meeting is very important. Apart from that, we already discussed about geopolitical tensions, geopolitical equations, the wars, okay, etc. So especially if there is a war in Middle East, then what does that mean? Middle East is the biggest supplier, the producer of crude oil. So what will happen? Supply will come down. When supply is coming down, what will happen? Price will skyrocket. So any war or any tension in Middle East is not accepted when it comes to crude oil. So the supply will come down as they are the major producers, and then the price will go up. So it is not good. Any tension in Middle East is not good when it comes to crude oil. It also, let's say Russia-Ukraine war. Okay, this also have a significant impact because Russia is also a very good producer of crude oil, and Israel-Palestine issue is also very important. Okay, so all these are very important. And when it comes to other aspects, natural aspects, weather play very important role, especially when it comes to if there is tsunami, then what is the problem? The production will be affected. Okay, if there is tsunami, if there is hurricane, high tides, the production will be affected, transportation will be affected, the ships won't move properly, or it takes some time when it comes to transportation, drilling and other things. So bad weather will also affect crude oil. Wars will affect crude oil. Any tension in Middle East will affect crude oil. Apart from that, OPEC meetings will affect crude oil. If they decide together, they make a cartel and then they decide that they are going to increase the price, that will definitely affect. Or if they are going to decide that they are going to reduce the supply or the production collectively, that will affect the price. Similarly, if you see US unemployment data, very important, but not as important as inventory. US unemployment data that also you will get from economic calendar, and then payroll report. These will be coming once in a month. So these are the things that you need to focus on. Guys, the technical aspect and everything I'll be discussing in the coming session. The strategies I'll discuss in the coming session. So see you in the next video. Thank you so much.